Stock Market Education Series Video Number 12, Short Selling and Margin Trading, High Risk, High Reward Strategies. Welcome back to our Stock Market Education Series. In our last episode, we compared different trading and investing strategies, including day trading, swing trading, and long-term investing. Today, we're diving into two high-risk, high-reward strategies, short selling and margin trading. These techniques can amplify gains but also expose traders to significant risks if not used correctly. Let's get started. Before we break down these strategies, it's important to understand that both short selling and margin trading involve borrowed money or assets, meaning they come with a much higher level of risk compared to traditional investing. Now, let's start with short selling. What is short selling? Short selling, or shorting, is a strategy where traders bet against a stock, profiting if the stock price goes down instead of up. Unlike regular investing, where you buy low and sell high, short selling involves selling high first and buying low later. Here's how it works. A trader borrows shares of a stock from a broker. The trader sells the borrowed shares at the current market price. If the stock price drops, the trader buys back the shares at a lower price. The trader returns the borrowed shares to the broker and keeps the difference as profit. Let's say a stock is trading at $100 per share. A trader believes the price will drop, so they borrow 100 shares and sell them for $100 each, making $10,000. If the stock price falls to $80, the trader buys back the 100 shares for $8,000 and returns them to the broker, making a $2,000 profit. Risks of short selling. Short selling carries risks like unlimited loss potential. Since a stock price can theoretically rise indefinitely, short sellers can face unlimited losses if the stock price skyrockets. Margin calls. Brokers may require traders to deposit more funds if the stock price rises significantly, leading to forced liquidation. Short squeezes. If too many traders are shorting a stock and the price suddenly rises, they may be forced to buy back shares at higher prices, driving prices up even more. Famous examples include the GameStop short squeeze of 2021, where hedge funds lost billions as retail traders drove up the stock price, forcing short sellers to cover their losses at extreme prices. What is margin trading? Margin trading involves borrowing money from a broker to trade with more capital than you actually have. This allows traders to take larger positions and potentially magnify profits, but it also increases risk. How margin trading works. Here's how margin trading works. A trader deposits a certain amount of money in a margin account. The broker lends additional funds to the trader, allowing them to buy more stocks than they could with just their own money. If the trade is profitable, the trader keeps the gains after repaying the borrowed funds. If the trade loses money, the trader is responsible for repaying the loan, which can lead to significant losses. Example of margin trading. A trader has $5,000 and uses a 2-to-1 margin to buy $10,000 worth of stocks. If the stock price increases by 10%, the trader's profit is doubled to 20%, resulting in a $2,000 gain instead of $1,000. However, if the stock price drops by 10%, the trader faces a 20% loss, meaning they lose $2,000 instead of $1,000. If losses continue, the broker may issue a margin call, requiring the trader to deposit more money or sell positions to cover losses. Risks of margin trading. Margin trading can lead to magnified losses. Just as margin amplifies gains, it amplifies losses, meaning traders can lose more than their initial investment. Margin calls. If losses exceed a certain level, brokers can force traders to deposit more money or sell assets at a loss. High interest rates. Brokers charge interest on borrowed funds, which can eat into profits if positions are held for too long. Comparing short selling and margin trading. Short selling involves borrowing stocks and profiting from a decline in price, while margin trading involves borrowing money to increase buying power. Both strategies require a margin account and come with significant risks. Short selling carries unlimited risk since a stock's price can rise indefinitely, forcing traders to buy back shares at a much higher price. In contrast, margin trading allows traders to take larger positions, but losses can exceed their initial investment if the trade moves against them. When should you use these strategies? Experienced traders use short selling and margin trading to hedge risks or amplify gains. Day traders and swing traders may use margin to trade larger positions. Short selling is best suited for traders who understand market trends and can predict declines in stock prices. Margin trading can be useful in a rising market but must be managed carefully to avoid excessive losses. Key takeaways: short selling allows traders to profit from falling stock prices but comes with unlimited risk. Margin trading allows traders to borrow money to increase buying power, but it can amplify losses if trades go wrong. Both strategies require a margin account and careful risk management to avoid significant financial losses. In the next video, we'll discuss market psychology and behavioral finance, exploring how emotions like fear and greed influence investor decisions and market movements. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Tell us in the comments, have you ever used short selling or margin trading? What was your experience? Let's discuss. Thanks for watching, and we'll see you in the next video.